Look, I've been doing this for 50 years, and I can tell you with absolute certainty that the biggest opportunities in the world right now are sitting in places where most American investors won't even look because they're too busy chasing whatever garbage narrative CNBC is selling them this week. Emerging markets, everyone talks about them when they're hot, everyone abandons them when they're cold, and almost nobody actually understands what creates value there. And that's exactly why the opportunity exists. Let me be very clear about something. The reason most people lose money in emerging markets isn't because emerging markets are inherently risky. It's because they don't understand the fundamentals. They treat these investments like lottery tickets instead of analyzing them the way you'd analyze a building in Chicago or a business in Dallas. They get excited about growth rates without asking who captures that growth. They fall in love with GDP projections without understanding property rights. They confuse activity with profit. And then when things go sideways, they blame the market instead of their own intellectual laziness. I've made a career out of buying things that other people are afraid of. Distressed debt, real estate in recessions, assets trading below replacement cost. The entire playbook is built on one simple insight. Fear creates mispricing, and mispricing creates opportunity. But you have to have the stomach for it. You have to be willing to look stupid for a while. You have to be able to ignore the crowd. And right now, the crowd is ignoring emerging markets almost entirely, which tells me it's time to pay very close attention. Here's what I see. That the developed world is drowning in debt, dealing with aging demographics, and fighting over smaller and smaller pieces of a pie that isn't growing much anymore. The United States has printed so much money over the last 15 years that we've essentially turned capital into a free commodity. And when capital is free, discipline disappears. Europe is sclerotic, overregulated, and terrified of its own shadow. Japan has been trying to inflate its way out of demographic decline for 30 years. These are not high-growth environments. These are mature, saturated markets where every basis point of return is being fought over by armies of overpriced analysts and algorithm traders. Meanwhile, you've got countries with young populations, rising middle classes, infrastructure needs that are almost incomprehensible in scale, and governments that are finally, slowly starting to understand that property rights and rule of law actually matter if you want capital to show up. I'm talking about parts of Southeast Asia, Latin America, Africa, South Asia. These aren't monolithic places. You can't just say emerging markets and throw a dart. You have to do the work. You have to understand which countries have actual reform momentum and which ones are just talking. You have to know the difference between a place with corrupt institutions and a place with improving institutions. That distinction is everything. The conventional wisdom right now is that emerging markets are too risky because of currency volatility, political instability, regulatory uncertainty, all the usual concerns. And you know what? Those concerns are real, but they're also priced in. When everyone is scared of the same thing, that fear gets reflected in valuations. You can buy assets in certain emerging markets today at valuations that would be unthinkable in New York or San Francisco. You can find businesses trading at 6 or 7 times earnings that would trade at 20 times earnings if they were domiciled in the US. You can buy real estate in growing cities at a fraction of replacement cost. Why? Because the risk premium is enormous. But if you actually understand the risks, if you can separate the real ones from the imagined ones, that risk premium becomes your margin of safety. Let me tell you what I look for. First, I want demographic momentum. I want a young population that's moving from rural areas to cities, from agriculture to services and manufacturing, from subsistence to consumption. Urbanization is one of the most powerful economic forces in human history, and it's still happening at massive scale in emerging markets. When people move to cities, they need housing, they need infrastructure, they need goods and services. That creates demand, real demand, not the fake demand you get from monetary stimulus or government subsidy, but actual human beings wanting actual things. Second, I want to see barriers to entry. This is critical. Growth is worthless if anyone can come in and compete it away. I want markets where there are natural or structural barriers that protect returns. Maybe it's a regulated industry. Maybe it's a business that requires local relationships and knowledge that foreign competitors can't easily replicate. Maybe it's real estate in a supply-constrained market. The point is, I want some kind of moat. I want something that prevents the next guy from doing exactly what I'm doing and driving my returns to zero. Third, I want liquidity or a path to liquidity. This is where a lot of people screw up. They fall in love with an asset or a market and forget that at some point they need to be able to sell. Illiquidity is fine if you're getting compensated for it, but you better understand what you're signing up for. You better have a long time horizon and deep pockets. I prefer situations where there's enough market depth that I can exit if I need to, or where there's a clear mechanism for monetization, whether that's dividends, asset sales, or an eventual IPO. Fourth, and this is non-negotiable, I want rule of law. I don't need perfection. I don't need Switzerland. But I need to know that contracts are enforceable, that property rights are respected, that there's some reasonable expectation that the government isn't going to expropriate my assets or change the rules overnight just because they feel like it. This is why you can't treat all emerging markets the same. Some countries are making genuine progress on governance and institutions. Others are backsliding. You have to pay attention. You have to understand the political economy. You have to know who's in charge and what incentives they're operating under. And fifth, I want free cash flow or a clear path to free cash flow. I don't care about growth for the sake of growth. I don't care about market share if it's being bought with subsidized pricing. I want to see businesses that generate cash, that can reinvest that cash intelligently, and that can return cash to shareholders. Too many emerging market companies are run like empires, not like businesses. The founders or controlling shareholders treat them as personal fiefdoms. They prioritize size over profitability, revenue over returns. I'm not interested. Show me the cash flow or show me the door. Now, let me address the elephant in the room, currency risk. Everyone freaks out about currency risk in emerging markets. And yes, it's real. If you invest in a country with a weak or volatile currency, you can get killed on the exchange rate even if the underlying asset performs well. But here's the thing. Currency risk is also an opportunity. When a currency is beaten down, when everyone is terrified of it, that's often the best time to buy. You're getting assets at a discount because of the currency, and if the currency stabilizes or strengthens, you get a double benefit. The key is not to fight the currency. Don't hedge unless you have a very specific reason. Instead, invest in businesses that generate hard currency revenue or that benefit from a weaker currency through exports. Let me give you a framework for thinking about this. Emerging markets are not an asset class. They're a collection of very different countries with very different circumstances, and you have to evaluate each one individually. But broadly speaking, there are three types of opportunities I'm looking at right now. The first is real estate in cities that are still urbanizing rapidly, but where supply is constrained by geography, regulation, or lack of capital. I'm talking about prime locations in cities like Jakarta, Manila, Nairobi, Lagos, Sao Paulo, Mexico City, places where the middle class is growing, where people want to live in modern buildings with reliable infrastructure, and where the existing supply is inadequate. The key is to buy well-located, well-constructed assets that can generate rental income in hard currency or inflation-indexed local currency. You don't want to speculate on land in the middle of nowhere. You want income-producing properties in proven locations with real demand. The second is businesses that serve domestic consumption, particularly in countries with large and growing middle classes. I'm looking for companies that sell things people need and want: food, beverages, healthcare, education, financial services, telecom. These are not sexy businesses. They're not going to get written up in TechCrunch. but they're cash generative, they're resilient, and they benefit from long-term demographic trends. The mistake people make is chasing the high-growth tech darlings that are burning cash and praying for an exit. I want boring, profitable businesses with pricing power and recurring revenue. The third is infrastructure and logistics. Emerging markets have massive infrastructure deficits. Roads, ports, airports, power generation, water treatment, you name it. And as these economies grow, that infrastructure has to get built. Now, I'm not talking about taking construction risk or political risk by building greenfield projects in unstable environments. I'm talking about acquiring existing infrastructure assets that generate regulated or contracted cash flows, or investing in logistics companies that benefit from the growth of trade and e-commerce. These are long-duration assets that can produce steady returns if you buy them right. Here's what I'm not interested in. I'm not interested in commodity exporters unless I'm getting them at a massive discount and I understand the commodity cycle. Too many emerging market economies are over-reliant on natural resources, and when the commodity cycle turns, they get crushed. I'm not interested in state-owned enterprises unless there's a clear and credible privatization or reform process underway. I'm not interested in anything that depends on government subsidies or politically connected contracts, because those can disappear overnight. And I'm absolutely not interested in companies with opaque financials controlling shareholders who treat minority investors like garbage, or governance structures that give me no rights. The other thing I want to talk about is the macroeconomic backdrop, because it matters. For the last 15 years, emerging markets have been fighting against a headwind of US dollar strength and capital flowing back to the US because of quantitative easing and interest rate differentials. When the Fed is printing money and keeping rates at zero, capital sloshes around looking for yield, and a lot of it goes into US assets. When the Fed tightens, that reverses. Emerging market currencies weaken, capital flows out, and asset prices get hammered. We've seen this cycle play out multiple times. But here's the opportunity. That outflow creates the mispricing. When capital is fleeing emerging markets indiscriminately, you get situations where high-quality assets are trading at distressed valuations just because they happen to be in the wrong geography. That's when you step in. That's when you buy. Not when everyone is excited and pouring money in, but when everyone is running for the exits and you can negotiate from a position of strength. And let's talk about China for a minute, because you can't talk about emerging markets without talking about China. China is not an emerging market anymore in the traditional sense. It's the second largest economy in the world, but it's also facing massive structural challenges: debt, demographics, a property market that's imploding, a tech sector that's being strangled by regulation, and a government that seems more interested in control than growth. A lot of people are terrified of China right now, and I understand why. But fear creates opportunity. There are assets in China that are trading at absurd valuations because everyone is scared. If you can identify the ones that will survive and thrive despite the challenges, the returns could be extraordinary. But you better know what you're doing. You better understand the political risk, and you better be prepared to lose everything if you're wrong. The same logic applies to other markets. India is probably the most exciting large emerging market right now. Young population, pro-business reforms, growing middle class, improving infrastructure. But valuations are high. You're not getting bargains in India the way you might in other places. So you have to be selective. You have to find the companies that can justify the multiples. Brazil is a perennial disappointment, but it's also one of those markets where you can find incredible opportunities if you're patient and disciplined. Mexico is benefiting from nearshoring as companies move supply chains closer to the US, and that's creating real investment opportunities in manufacturing and logistics. Southeast Asia is fascinating. You've got countries like Vietnam that are growing rapidly, and attracting manufacturing investment. You've got Indonesia, the fourth most populous country in the world, with huge domestic market potential. You've got Thailand, which is more developed but still has opportunities. And then you've got frontier markets like Bangladesh and Pakistan, which are too risky for most institutional investors, but offer asymmetric returns if you can stomach the volatility and do the work. Africa is the wild card. It's the last frontier in a lot of ways. Massive population growth, urbanization, a young demographic, but the challenges are enormous. Weak institutions, political instability, inadequate infrastructure, fragmented markets. You can't go into Africa with the same playbook you'd use in Asia or Latin America. You have to be willing to partner with local operators who understand the environment. You have to be willing to take a very long-term view, and you have to be very selective about which countries and which sectors you're willing to touch. Now, let me bring this back to the fundamentals, because that's what actually matters. Emerging markets are not a bet on GDP growth. They're not a bet on currency movements or commodity prices or any macro narrative. They're a bet on finding assets that generate cash flow, that are trading below intrinsic value, and that have a margin of safety. Everything else is noise. The mistake most investors make is they get seduced by the story. They hear about the rising middle class or the infrastructure boom or the tech revolution, and they pile into whatever investment banks are marketing to them without doing the homework. They don't look at the balance sheet. They don't understand the governance. They don't know who the controlling shareholders are or what their incentives are. They don't think about exit scenarios, and then they wonder why they lose money. I approach emerging markets the same way I approach everything else. I want to buy $1 for 50 cents. I want assets that are undervalued relative to their cash generating capacity or replacement cost. I want management teams or operators that have skin in the game and are aligned with my interests. I want downside protection, and I want a catalyst, something that's going to unlock value over a reasonable time horizon. The opportunity in emerging markets right now is that almost nobody is looking. Institutional investors are underweight. Retail investors are scared. The narratives are all negative, and that's exactly the environment where you can find mispriced assets. But you can't be lazy. You can't rely on index funds or ETFs. You have to do the work. You have to understand the specific countries, the specific sectors, the specific companies. You have to be willing to travel, to meet management teams, to walk the properties, to see the businesses with your own eyes, and you have to be patient. Emerging market investments are not get-rich-quick schemes. They're long-term commitments. You have to be able to sit through volatility, through currency swings, through political noise. You have to believe in the fundamentals and trust that over time, value gets recognized. That's hard. It requires discipline and conviction, but that's also why the returns can be so extraordinary. Here's the reveal I promised you. The specific opportunity I'm watching right now is in the intersection of real estate and demographics in Tier 2 and Tier 3 cities in emerging markets. Everyone focuses on the big gateway cities, the capitals, the obvious places, but the real action is happening in secondary cities that are benefiting from urbanization, but where supply is still extremely limited. These are cities with populations of 2, 3, 5 million people, growing rapidly, developing middle classes, but where there's almost no institutional quality real estate. You can buy or develop assets in these markets at a fraction of the cost of the primary cities. And the yield profiles are significantly better because there's real scarcity and real demand. I'm also looking very closely at healthcare infrastructure in countries with aging populations and rising incomes, places like China, Thailand, parts of Latin America. There's a massive undersupply of quality healthcare facilities, and as people get wealthier and older, they demand better care. Hospitals, clinics, senior living facilities, these are all areas where there's going to be sustained demand and limited competition if you can execute well. So here's what I want you to do. Stop chasing the narratives. Stop listening to the noise. Start looking at the numbers. Start understanding supply and demand. Start thinking like an owner, not a speculator. Ask yourself, does this asset generate cash? Can I buy it below replacement cost? Is there a barrier to entry? Is the governance acceptable? Can I exit if I need to? If the answer to those questions is yes, then you might have an opportunity. If the answer is no, move on. Subscribe to this channel if you want to keep thinking like an owner instead of getting sold whatever Wall Street is peddling this week. Hit the like button if you appreciate the fact that I'm not here to make you feel good. I'm here to make you think. And leave a comment with your own investment thesis or your doubts about emerging markets. And I'll try to answer honestly, even if the truth is uncomfortable. Because the only way to make money is to see things clearly. And clarity is a hell of a lot more valuable than optimism. Love.